Welcome to The Explainer. Today we are digging into a huge question for pretty much any investor. Are ETFs and index funds the smartest way to grow your money, or are you just settling for average? Let's break it all down. All right, here's where we're headed. We're going to start with the high-stakes game of investing and why it's so tough. Then, we'll look at a much simpler way. After that, a performance showdown. We'll also see why you can't just buy any ETF. Then we'll uncover a secret weapon: taxes. And finally, we'll land on the big question: index funds or picking your own stocks? Let's jump in. Okay, first up, the high-stakes investing game. We all dream of finding that next big thing, right? But man, is it a lot harder than it looks. For a lot of people, the stock market just feels like a giant casino. You're putting your money down, crossing your fingers, hoping you pick the right company at exactly the right time. But is that all it is? Just a game of chance? And this quote from the University of New Hampshire just nails it. When you're just starting out, it's just daunting. The number of choices is totally overwhelming. And it's not just about how hard it is to find a winner, it's about the very real risk of picking a big loser. I mean, think about it. When you put all your eggs in one basket, one single company, you're completely exposed. A bad call from the CEO, a new competitor pops up out of nowhere, a big market shift, any one of those things can completely wipe out your investment.
So if that's the problem, what's the solution? What if you didn't have to find that one perfect stock? Well, there's another way. Let's talk about the alternative that pretty much changed the entire game of investing.
And here it is. This is the whole idea, in a nutshell. Instead of spending all your time and energy trying to find that one single needle in a massive haystack, what if you just bought the whole haystack? You're not betting on one company. You're betting on the entire market. The first big innovation here was the index fund. It's a kind of mutual fund with a really simple job. Just copy a market index, like the S&P 500. So with one single purchase, boom, you own a tiny piece of the 500 biggest companies in the US. Instant diversification. Then, things evolved. The exchange-traded fund, or ETF, came along. It's based on the exact same idea, tracking an index, but with one massive difference. It trades on a stock exchange, just like a share of Apple or Microsoft. That means you can buy or sell it anytime the market's open, which gives you way more flexibility. So let's break that down, because this is the key difference. ETFs trade like stocks. Their price is constantly changing, all day long. A traditional index fund, though, that's a mutual fund. It only gets priced once at the end of the day. And this little difference in how they trade has a huge impact on flexibility and, as we're about to see, your tax bill. Okay, so the theory sounds pretty solid, right? Buy the whole market, keep it simple. But how does it actually play out in the real world? Let's get to the performance showdown and look at the actual numbers. Now take a look at this. This chart shows a 10-year run comparing a basic tech ETF against some of the hottest individual tech stocks. And as you can see, before we even think about fees, the ETF is right there in the mix, keeping pace. But that's just part of the story. Because now, let's add the fees into the equation. Those tiny little percentages you see, they don't seem like much, but over time, they are a huge deal. And this is where the low cost of the ETF really starts to shine, giving it a real edge in the long run. Yeah, there's a name for this. It's called fee drag, and it's called that for a reason. It literally drags down your returns year after year. The higher that fee, the more of your hard-earned money is going into someone else's pocket instead of growing for you. But, and this is a big but, it's not a magic bullet. A really comprehensive study found that a staggering 60% of ETFs actually underperformed the market. And a lot of times the reason is those very fees we just talked about. This leads us to a really, really important point. Which is this: not all ETFs are equal, not even close. The world of ETFs is so much bigger and more complicated than just buying an S&P 500 fund. There's a whole universe of these things, and frankly, some of them are incredibly risky. For example, have you ever heard of an inverse ETF? The idea is that it does the exact opposite of the market. So if the market drops 1%, this fund is designed to go up 1%. It sounds like a cool way to bet against the market, but they use really complex stuff to make it happen, and that's where the danger is. And this is the trap. It's called volatility loss, and it is absolutely brutal. Look at this example. You can be 100% right that the market is going to go down. You predict it perfectly, and you can still lose half your money. Because of the math and the daily resets, a choppy market will just eat your investment alive. Okay, so we've seen the dark side, but let's swing the pendulum back.
because ETFs have this incredible secret weapon that almost nobody talks about. And that secret weapon is taxes.
JP Morgan really hit the nail on the head here. The very way ETFs are built, their fundamental structure, gives them this massive tax advantage. And over the years, that can make a huge difference in how much money you actually get to keep.
So how does this work? Well, it's basically a three-part trick. First, when you sell your ETF share, you're selling it to another investor, not back to the fund, so the fund itself doesn't have to sell stocks and trigger a tax bill. Second, there's a special process where big players can swap shares for actual stocks without it being a taxable sale. And third, the fund can use that process to get rid of its oldest, lowest-cost shares, which lowers the whole fund's future tax bill. It's really clever, and it saves you money.
All right, we have been through a lot. The good, the bad, the complicated. So now it's time to bring it all home and tackle that final, massive question. Are you better off with index funds, or should you be out there picking your own stocks?
Here's a quick side-by-side to make it simple. With ETFs and index funds, you get instant diversification, usually low costs, and high tax efficiency. But you're pretty much signing up for the market's average return. With individual stocks, the dream is to beat the market, but it comes with way less diversification, a lot more risk, and a ton more homework for you.
And this is a thought I want to leave you with. The market is always changing. For years, the story was all about a handful of giant tech companies just pulling the whole market up. But we're starting to see that broaden out. Some experts think we're heading into a stock picker's market where choosing the right individual companies is going to matter more than it has in a long time. So the question for your own strategy is this: are you happy to just ride the market's wave, or is it time to try to beat it?